Hi, everyone, and thank you for joining us today. Before we introduce our guests and get started, I need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts an informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, jokes, or ideas or principles expressed by presenters are their own, and however funny or true or interesting they are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional first. We're thrilled to bring you this educational presentation. Attendees are muted, and we encourage you to ask questions using the chat box. The presenters will answer those queries during or after the webinar today as appropriate. If you have a question, be sure to put it in the chat box and go ahead and leave your phone number as well. If we can't get to your question during the event, we'll make sure somebody reaches out to you after today's event. We want this experience to be as educational as possible, so please do not hesitate to ask for clarification or expansion of the material. And with that, I would like to introduce to you today's presenter. Robbie Schoonmaker has helped individuals for over 20 years to reach their financial goals. He worked at PricewaterhouseCoopers and Arthur Andersen as a tax and financial planning professional, helped ultra high net worth families at a multifamily office, and managed a real estate for a family office for over a dozen years. In addition to helping individuals through his own practice, Robbie is a certified financial planner professional, a certified public accountant, and a registered life planner. He has a master's degree in accountancy and a bachelor's degree in history. And with that, I pass it off to you.
Thank you. Appreciate it. Thanks for being here, everybody. That's kind of the technical stuff about me. A couple personal things. I'm single father of 8 kids, which is a bit crazy. And I love going out in the wilderness, exploring the mountains, and really having all kinds of new experiences, learning new things and learning new stuff about myself too. So I think that's all important as we look at financial planning, as we look at this specific topic, incentive stock options, because there's a lot of technical things that we're going to look at in this webinar. But the first thing that's important really is your particular life and what's happening for you. So while we're going to get into all these details, I just want to set a structure to keep in mind as you start to look at your own stock options. First thing to keep in mind is there are tax decisions to be made here, and we're going to talk a lot about taxes. That's the majority of the details here with incentive stock options. But really, this may be an investment decision more than a tax decision, because the tax benefits you'll receive here, as we'll cover, require you to wait a certain amount of time to receive them. And sometimes it makes more sense to pay attention to the stock or the value or what's going to happen to that in the meantime. You could lose your tax benefit simply by a drop in stock price. So that's a consideration. And then also, ideally, you're going to look at what's the decision that's best for my life, for my lifestyle, rather than just even the investment decision, let alone the tax decision. So I want to walk you through that real quick, a type of way to think about this. When you've got these options and there's a lot of value there, you want to ask yourself, maybe, what do you ideally want to do? What's most meaningful to you? What are you trying to accomplish with these dollar signs that are sitting out there in your options? And once you know what you're trying to accomplish, then you want to look potentially at what the current valuation is, and is that getting you there? Is where your options are currently valued actually going to enable you to make a shift? Because there's risks to continuing to hold on to this. So once you have a concept of what you want to accomplish, and you have a concept of how much value you may have in the options and what you could do with it, then you ask yourself, how much liquidity do I need now to do something with my life? And that leads into then, how do I efficiently create that liquidity to do this. And so you want to kind of look at your life in general and be asking yourself, what do I want to accomplish? And keep that in mind rather than just looking at overall value and what could be more in the future. It may be that you can maximize your life right now. And if you make more money, it doesn't really matter. So keep that in mind as we go through all of the details here. So let's dive in a little bit. We're going to talk specifically about incentive stock options today, as opposed to non-qualified stock options. So I just want to point out that Advice Chaser does have a webinar we've done in the past with some more basics about non-qualified stock options and ISOs, or incentive stock options. Take a look at that if you need some more background than what we're going to do here today, because we're going to get a little more detailed. So when you're looking at incentive stock options, you get these from your employer. A couple things to note in comparison to the non-qualified stock options is, number one, these are not subject to employment tax. So the Social Security, the Medicare component, that does not apply to ISOs. And in addition, the main potential benefit here is that these stock options are not necessarily subject to ordinary income tax. All of the income associated with it in the normal tax system, you can potentially convert to long-term capital gains. And in order to do that, you have to exercise the stock and hang on to it for a year before you sell it. So that is your primary benefit. And so as we look at selling them, you've got two ways to classify this. You're either going to have a qualified or a disqualifying disposition. So let's walk through that real quick. On the next slide here, you can see a qualified disposition is one where you've been granted the option and you've exercised it and held on to it for at least a year. And in addition, 2 years have passed since the time that it's granted. Now, generally what we see is when your employer grants you these ISOs, they'll grant it to you and the first batch of them don't vest for a year. So if you then exercise and hold for a year, you've automatically qualified for that 2-year provision. So usually we're not too concerned about that. But if you qualify for this, then all of the income associated with this is long-term capital gain. If you don't meet those specifications, if you exercise the option and then you sell it immediately or sell it in less than a year, then the gain on the option between the strike price that you paid for it and the fair market value of it at the time that you exercise, that becomes ordinary income instead of long-term capital gain. That's the primary potential benefit from the ISOs. So let's take a look at a timeline of what the tax effects are as we do this. So when your employer grants you these options, that's when they give you the grant and they tell you how many shares you have and when they will vest, what the schedule is. There's no tax effect. Those aren't yours yet. And so they're not realized income and the IRS is not taxing. Now, there comes a date where they vest, and that means that they're now yours and you can exercise them generally whenever you want up until the date that they expire. Got to make sure you exercise before they expire. But when they vest, there's still no tax effect to you. So the first important date then is when you exercise the options. Now with non-qualified stock options, when you exercise it and you now hold a share of stock from your company, that becomes taxable income date. There's income realized on that date. With incentive stock options, with ISOs, that's not the case. There's no ordinary income recognized on that date. Now there's an alternative minimum tax effect, and we're going to talk about that. But on the exercise date, there's no tax. So if you then hold the stock for a year and you sell it, that's when you realize long-term capital gains. We'll walk through some examples of this to get in more detail. And I note too, we're going to kind of fly through this. There's a lot here, but this will be posted. You can go watch it again to try to get into the details of it and understand if you don't quite catch it the first time through. Okay, so let's look at the next example. If you're disqualifying these stock options, then you're going to be holding them for less than a year. So once again, when the option's granted, when the option vests, there's no tax effect. When you exercise, there's again no ordinary tax effect. But once you sell the stock and it hasn't been a year, then you realize ordinary income. This is subject to the ordinary income tax brackets, 12%, 22%, 25%, et cetera, on up to currently 37%. And then if the stock's gone up in value, there's potentially a short-term capital gain as well. But it doesn't qualify for the long-term capital gain tax rates. That's the basic structure on the ordinary tax side. Let's take a look at the alternative minimum tax side. This is where incentive stock options get a little bit crazy. So the alternative minimum tax system is essentially a second way to calculate your income tax that's calculated parallel to the regular version. And what the system does is you go through and you calculate your tax the regular way. You calculate it according to the alternative minimum tax system. And whichever one is higher is the one that you have to pay for the year. So this comes into play when you have incentive stock options, because while you don't recognize ordinary income when you exercise the stock, you do recognize income for alternative minimum tax for AMT purposes. We're going to look at that in just a second, how that works. But that leads to potentially paying extra tax in the year that you exercise these options. Now, it creates a credit as well. That's a credit forward, carry forward, that you may be able to recover this extra tax that you pay. You may be able to recover it in future years. But it's important to note that you don't necessarily recover it in future years. We'll look at the details in a second here. But it's important to look at the whole situation, because you're essentially taking money and paying it to the IRS, hoping to get it back in the future, but you may or may not get it back in the future. And so the whole concept of these ISOs of paying lower tax may or may not actually work for you, depending on the specific situation. So let's take a look at the IRS form that's used to calculate alternative minimum tax. We're definitely not going to look at the whole thing, but to just walk through the basic concept of how this is calculated, so you understand how this may or may not work for you in the future. So line 1 on this form, this is the calculation for alternative minimum tax. Line 1 starts with your adjusted gross income from your normal calculation. So essentially, you're adding up all your income in the normal tax system, and the AMT calculation starts with that. So then it's making adjustments to this income number. And there's a variety of them on here, but the big ones we're going to worry about first is on line 2I. It's the exercise of incentive stock options. So this is where you've got we start with the same amount of income as the regular tax system, but when you exercise ISOs, now your income is higher for AMT purposes. We'll note that line K is where there's an adjustment for disposition of property. What that is when you exercise these incentive stock options and your income increases because of it for AMT purposes, now you own a share of stock that has higher basis than the ordinary stock. So when you sell it, you may get a decrease in your income for AMT purposes. So if we follow down the form just to line 4, you add up the alternative minimum taxable income and they calculate the tax on it using different tax rates than ordinary tax rates. And if we look down at line 9, this is tentative minimum tax. Based on that increased income amount for AMT purposes, they now calculate the tax amount on line 9. Line 10, we enter the tax amount from the regular tax system. Now we just compare the two. And if line 9, the AMT amount is higher, then you end up on line 11 paying tax the first year. Now, real quick, that just works the opposite way in the second year. If you sell the stock, you get a negative income adjustment on line 2K. So your income on line 4 is lower than it is on line 1. So now when we calculate the tax on line 9 for AMT purposes, that's lower than the tax on line 10. And the difference between the two, in short, There's some other factors, but in general, that becomes the credit amount that you can recapture. So it's a confusing system because there's multiple sides of it and multiple factors. So what I want to do is walk through some examples, but I want to point out first the main difference, the main potential benefit for ISOs is saving on long-term capital gain rates versus ordinary income rates. And so in general, the concept is rather than paying the ordinary rates of 22, 24, 35, 37%, you can change all that income to long-term capital gain at a 15% or an 18.8 or a 23.8% rate. And so the dollars that you're saving depend on how much your gain is in the stock and how much the spread is between the capital gain rate and what your personal ordinary income tax rate is. It's very situation specific. And so that may or may not have a big dollar difference for you, depending on the gain and depending on the rest of your tax situation. But gaining that benefit over the course of 2 years, once you recover the AMT credit or however many years it takes you to sell the stock, that comes at a potential cost. So there's two things to consider. One is that the price of the stock could actually drop in the meantime. So if you're holding on to this stock to try to save $5 per share in tax, and the value of the stock drops by $10, then you've lost all your benefit. You may have a tax benefit, but in essence, you have less money anyway. So there's a risk to exercising and holding these ISOs. And in addition, you may have to pay the IRS money up front for the AMT tax. And depending on what happens with the stock and the rest of your tax situation, we don't know for sure when you'll get that money back. These things are designed so that you get it back when you sell the stock, but it depends on some circumstances. So that's what we want to walk through at this point in time, is some detailed examples of how this might work or how it might backfire on you. So we're going to look at both the regular tax situation and the AMT situation for all of these scenarios. So I'm just going to take a quick breath and a drink so I don't cough. And if there's any questions, feel free to put them in the chat or you can let me know, and then we will dive right into these. Okay, let's get going. Here's the fun part. I would encourage you as we go through these, there's a lot of detail in here to hear, but I am going to get to a sum up to so what of all these examples. And if you can't remember how it all works, that's okay. What's important to remember is that the basics that you hear about how this works, about saving taxes through ISOs, may or may not work for you. And it's important to do analysis on it to make sure you understand the risks that you're taking. So here we go. This first example is the ideal situation. It's how these are supposed to work. So you exercise these options, and then you're going to hold the share for more than a year. And the stock goes up in value. There's a gain inherent here between when you exercise and when you sell it. So when that happens, as we've already covered, as I've already said, you have long-term capital gain for regular tax purposes. On the AMT system, in the year that you exercise, you realize income, your income comes up and you pay some tax. And then in the year that you sell it, your income's lower for AMT purposes. You get an adjustment. That's any increase is also long-term capital gain, but that adjustment makes that AMT credit almost always kick in and you recover it. So to look at a specific example, let's say that for your stock, the strike price is $50. You exercised at $100, and then the stock goes up another $10 before you sell it. So in the regular tax system, no income is realized until you sell it, and that's the difference between the strike price and the sale price, or $60 of long-term capital gain. On the AMT side, the difference between the strike price and the exercise price, $50, is income in the first year. And in the second year, there's also $10 of long-term capital gain between the $100 and the $110. Those are the income realizations, and you also have that downward adjustment from the ordinary tax system. So this is how it should work. Hopefully your stock goes up. Hopefully you make a lot of money with it and you save taxes, and this is beautiful. Let's look at some twists with this. So the next example is if you exercise the stock and you're holding on to it, but you don't hold on to it for more than a year. Can we go to the next slide? There we go. So we need to look if there's a disqualifying disposition where you don't hold that stock for a year from exercise. There's two different potential tax effects depending on when you sell it within the year. And that difference is, do you sell it in the same calendar year as when you exercise, or do you sell it in the next calendar year, but before 12 months have passed? So in this first example, we're going to say that you exercise the stock and then you sell it in the same calendar year. So as we've mentioned before, there's ordinary income that's recognized for regular tax purposes and potentially a short-term capital gain. We'll go through that in a sec. And then for AMT purposes, there's no difference. There's no change. When you get to the AMT form, you've got your ordinary, your income from the regular tax system at the top, no adjustments. There's nothing different happening there. So the way this works is your strike price again is at 50. The exercise price is at 100. You exercise the stock and there's no income realized. And you're going along your way, and later in the year, the price has gone up $10 to 110. You decide you're ready to sell despite the tax consequences. So when you do that, because it's in the same tax year, there's no AMT adjustment. You don't have a qualifying disposition. There's no AMT adjustment. So you have $50 of ordinary income between $50 and $100, the difference between the strike price and the exercise price, and then a $10 short-term capital gain between that exercise price and the increased price. And now you're just done. Now you've handled it all. It's all on your tax return. There's nothing else to deal with. But it's a little different if we go to the next example, and you're going to be looking across different tax years. So we have the same thing happening, except for rather than, say, exercising in April and selling in November, you exercise in April and you sell in February of the next year. In this case, the ordinary side is the same. You recognize no income when you exercise and you rolled over December 31st, and now you're in February, and now you have that ordinary income and the short-term capital gain. But the AMT side is different. The AMT side makes its conclusions on December 31st. So once you've exercised and you've held that share, now you have an increase in your AMT income in the first year. And then when you disqualify the stock, you also have a short-term capital gain. But the problem is there's no downward adjustment due to the basis of the stock, because the stock that you sold in the regular system has the same basis as the AMT side. That's a little complex, but the thing to know is this. In short, the thing to take home is the way that you're most likely to get your credit back is if there's a downward adjustment in the year that you sell. And so if you exercise the stock, hold it over a tax year, and then sell it before the 1 year period, you don't end up with that downward adjustment. And now you're less likely to recover that credit, or it takes you longer to recover the credit. So just understand that if you cross a tax year, you've got a different decision to make with taxes than if you sell it before the tax year. And so just make sure you're getting help if you're doing that to understand your consequences. So let's switch now and look at examples if you exercise the stock and then the value of the stock goes down. So once again, we're going to look first at a qualifying disposition. This is where you exercise and hold for more than a year. And we're going to assume that the strike price is $50 and you exercise at 100 again, and then the price drops to 80. So for the regular tax system, again, this is still a long-term capital gain. For the AMT system, though, it's a little different. You've exercised and brought in all this income up to $100, and that's showed up on the AMT side. And now when you sell the stock, there is an adjustment that shows up, but it's less than you'd like because the value of stock went down. And in addition, you have a long-term capital loss that's showing up on the AMT side. And if you don't have a gain to offset that loss, you can't even necessarily use all of it. So again, let's walk through the specific numbers here. A strike price of 50, an exercise price of 100, and then a sale lower at $80. For regular tax purposes, you're still selling at 80, which is higher than 50, so there's still a long-term capital gain. But on the AMT side, you've recognized $50 of income, and when you sell it, it's dropped. So now you have a $20 per share loss that shows up. And on the AMT side, just like on the regular tax side, if you have huge capital losses, you can't necessarily take them all in 1 year. So now you're tracking on the AMT side a capital loss carryover, and you're tracking a credit carryover, and you may or may not be able to use the losses in the future. You may or may not be able to recapture the credit. So understand that if your stock drops in price, you've got a whole different risk and a whole different tax situation that you're dealing with. Let's take a look at the next example, which is holding the stock for less than a year and doing that in the same tax year. Now, remember, when we do this, everything gets settled in the ordinary tax system and AMT doesn't come into play. If you don't cross over the end of the year after you exercise your stock and you disqualify it before the end of the year, then it never hits the AMT side at all. So on the regular tax side, it's pretty simple. They've exercised at 100, strike price at 50, and the stock goes down and you sell it. Now you just recognize the income between the exercise price and where you sold it. Between the strike price and where you sold it. It's $30 of ordinary income that shows up on your tax return. Really, that'll show up on your W-2 from your company as income. Again, this gets more complicated if you do this across tax years. And this is where you can really start to see some problem with your taxes. When you're holding on to a stock across the tax year, remember, on the ordinary side, you recognize all the income in the second year. In this case, it would only be $30. But on the AMT side, you've recognized a lot of income in the first year. And now you have a loss because you're selling it at a lower price. And there's less income coming in on the regular side to create an offset in the AMT system. So you get this big income adjustment in year one. In year two, number one, you're not getting the adjustment on the downside. And number two, you have a capital loss that you may or may not be able to use. And what you end up seeing sometimes is that even now that you've sold these shares, your AMT income is very similar to your ordinary tax income. Therefore, no credit's being kicked in. And so you've paid all this tax in the first year. Now you've sold the stock, which is the event that hypothetically will kick in this credit, but you haven't used it. And now you're going on in your merry ordinary tax way with this big credit carryover from all this tax you've paid trying to save taxes that you may not recapture. What I've seen in the last few years with all the market volatility, some clients that have come in having exercised these and done it across tax years, is they may have AMT credit carry forwards that we're looking at it being 10, 15, 20 years before they recover them. So again, a lot of complicated things in there, but the thing to remember most is that you've got decisions to make all along the way. And there's a variety of potential tax effects and a variety of potential cash flow effects here. So let's, to summarize, it's complicated tax wise. There's decision points all over. And if you can get into this and understand this yourself, great. But I'll tell you, I can't back of the napkin this stuff. I have to run complicated tax projections in software because there's too many intertwining factors of what's going to affect it. It's not just the stocks that affect it. It's your income. It's your spouse's income. It's what deductions you have elsewhere. It's the character of the income on your return. All those things affect how your ISOs will be taxed, if and when you'll recover that credit, and whether it will actually work out for you. Another thing to keep in mind here is that you need to pay attention to the cash flow side of this. When you exercise these ISOs, you may need to come up with cash to exercise them. If you're planning on holding them for a year, you'd be coming up with cash and not selling the stock. Now, you may have a cashless exercise option, and those are just treated, as you've seen, as a disqualifying disposition. That's fine. But in either case, whether you do a cashless or a cash exercise, you may have to come up with cash to pay that AMT tax in the first year, even though you haven't sold the stock. And so you have to make sure you're looking forward to the tax year, projecting to see how much you have to come up with, seeing if you have cash from somewhere else to do it, or if you want to disqualify a certain amount of stock to pay the exercise price, and maybe more to pay the AMT effect to try to get a tax benefit, if that benefit is even worthwhile. So a lot of decision points there on the technical numbers side. And that includes the risk, the next point here, of the potential loss of value of the stock as you go over that year versus how much you're actually going to save in taxes, which may be a lot. If your strike price is really low compared to what the price of the stock is, there's a huge amount of gain in there, and that tax difference may be huge. If it's not that much higher, because you're continually receiving options, this isn't an IPO or something, the tax amount and the tax difference may be minuscule, and it may not actually make sense to hold on to it simply for a tax benefit. And the last thing is just bringing you back to the original point of the decision. There's numbers to get lost in here. There's all kinds of complicated analysis. But in the end, the question is, what difference does it make to your life? What are you trying to accomplish with these stock options? And therefore, what risks do you want to take? It may be that where the value is right now makes it to where it's worth exercising everything right now, because that would get you to the place that you could buy the country house that you want, or retire, or go on this trip before your kids get too old, or whatever the thing is that's important to you. And maybe that the value isn't that big, and you may want to take a risk of watching it double or triple or something, because that's the point that would change your life. And if you exercise now, that would be beautiful, and you could buy a new car or something, but it's not life-changing. You may choose to take more risk in order to get to somewhere life-changing. So in summary, all of the details, all of the numbers, all of that side is just helpful information to help inform your decision of what risks do I want to take to get my life to where I want it to be with this value that you have from the effort you've put in at work. And that is the main point, is let's change your life and let's make it the way that you want it to be through these options that you have. Samantha, I'm wondering if we've got any questions that have been posted.
No questions so far. So if you do have any questions, please feel free to add them to the chat, or you can even raise your hand on Slack, or not on Slack, oh my goodness, on Zoom, and we can take you off mute to ask them directly if that's something you're interested in.
Great.
So I'll just give a minute or two for that. Otherwise, we will go into outros. And as mentioned, we will be sending a link to the previous recording on this subject for some more in-depth introduction on this. So after this call, you will get a email from us. It'll include a link to the replay of this, where you can stop and screen share anything that was shared today. I know we had a lot of charts, a lot of really good numbers and in-depth examples shared for us. And you can also check out our other content and the previous content that led up to this.
Sure.
So I'll give it about probably
Yeah,
another 30 seconds.
I'll just say thank you to everyone for being here. And as I mentioned, go take a look at this if you want to understand the principles behind how these different decisions are running. And I would suggest in most situations, it probably makes sense to get some help on this analysis from a tax preparer or someone that understands the details, a planner, whoever. Make sure they know this because it's complicated, but that's the information that'll make a difference to you. So don't get too stressed about it. It's a great opportunity to have these. Just figure out how to make a difference in your life with it. Thank you.
Thank you very much. So with that, we will go to outros here. On behalf of Advice Chaser, we want to thank our speakers and the organizations that have worked with us to bring you this webinar today. Thank you so much for attending, and look out for an email soon with a link to the replay of this event. You're welcome to share that replay with your friends and your family. Here at Advice Chaser, we're all about helping you find a financial advisor who is a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anybody we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for coming, and we will see you at another webinar soon.